we're really focused on economic data at the moment. We've got Chinese numbers later today, of course, the unemployment numbers coming out for the Australian market in about an hour and a quarter's time or so. And, of course, yesterday and in previous days, lots of strong data coming through. There was the housing finance numbers, which potentially muddied the waters. We want to know what the chance of an interest rate hike is in April. Jim Stening joins us now from FIIG Securities to look at the issue and particularly to look at what the bond markets are expecting. Jim, thanks for your time.
Thank you.
Did the housing finance numbers, which came out yesterday, that 7.9% drop, do you think that in any way might change the outlook for the interest rates?
Well, perhaps in a small way. I guess, all of the statistics are viewed in total, I suppose, when these decisions are made. It's more about where we're going looking forward. I think one of the things that we saw yesterday from Dr. Lowe's speech was that housing prices are a concern. And so, one way to dampen enthusiasm there is to put up rates.
Okay, and so you think, net, looking across all the data, do you think we've got an increased chance of a rate hike in April? If you had to put a bet on it, where would you go?
So, yeah. Look, I think that the one thing's a certainty, we're going to get a rate hike in either April or May.
Yep.
Now, when you look at it, we've got inflation data coming out at the end of April. Really important. These quarterly inflation readings are becoming even more crucial. We've also got a federal budget in May. So I think also there's about 4 weeks until the next RBA meeting in April. And so there's a lot of data to come out until that date. But generally speaking, the trend is that the data is very positive and surprising on the upside.
What exactly are bond markets specifically looking for then?
Well, bond markets are factoring in these rises. I think we've talked about this before. Probably 4.5% to 5% by the end of the year is factored in. So I think what the bond market is really focused on is this inflation reading.
And still with an eye on offshore as well and the potential offshore risks?
Most definitely, most definitely. I mean, these things are still playing out. Obviously, there's been a bit of calming as far as the FIIGs go, but there's been a bit of a reigniting of nerves in respect to the UK.
Is that where the bond hounds are barking at the moment, given that Greece has kind of calmed down a bit, UK?
Yeah, most definitely. I think, a couple of the rating agencies have mentioned that they're concerned about the long-term prospects for the UK retaining a AAA rating. Now, that's a fundamental problem for the UK.
Exactly, how do you put a thought on how that would actually hurt them, a ratings downgrade for the UK, and how likely is that chance, though? Well,
it seems to me that if it continues in the current way, in a few years' time, their situation will deteriorate such that they will be downgraded. They're the noises we're hearing in chorus from the rating agencies. So that's what does that mean? That means that people demand a higher yield to take the risk to buy their bonds. It means that a lot of global players can't actually buy them because they fall outside of their AAA mandate. So it's problematic. It increases the cost of funds, generally speaking.
Once in a while we hear about the potential for the US to be downgraded, but that hasn't been on the cards for some time.
Well, no, I think that the concerns are with the UK. I think that their ratios are a little bit more extreme than the US.
Okay, also complaints, I guess you could call them, out of Greece this week from the Prime Minister about the speculators and how they've added to the woes or even caused the woes in terms of their situation. Is there any merit to the complaint that's being made about the speculators from the Greek Prime Minister?
Well, not in my opinion. I think that, if the speculators weren't in there, perhaps the problems wouldn't be addressed. I think that speculators speculate for a reason, and if an economy is going well, they'll speculate and they'll buy bonds, or credit default swaps, and vice versa. So, I think it's a fairly convenient distraction, really, from the underlying core problem.
And would you expect more regulation in that area?
Well, I think that's flagged across all of the derivatives markets. So yeah, I think we can expect that. But I think that derivatives do play a fairly important role in the management of risk in the global economy.
It does just put it back in the spotlight and put pressure on the leaders, though, doesn't it? When you get the calls for rein in the speculators, lots of people want to rally behind that idea. And I know that the Greek Prime Minister said that really should be on the agenda for the G20, and apparently President Obama was quite positive in his response. That was the wording. But
yeah, I guess so. But speculators are present in every market, and I think to isolate them to one structure or one derivative is a bit extreme.
Yep, sure. A debate still continues about the Commonwealth Health Plan as well, which has been unveiled recently. Do you see any potential ratings implications for the states within all of this?
Well, I mean, there very well could be. We're looking at this closely at the moment. Unfortunately, there's a little bit. It's not clear as to which states will be viewed as being efficient providers. So, some states it may mean more revenue, for others it may mean less. But I think from a bondholder's perspective, what you do require is some clarity around it. The longer there's a mystery or there's potential for movement in terms of ratings, then the longer people get nervous, I suppose.
And do you think this is top of mind for the states, that issue, or?
Yeah, I think it always is. I mean, raising debt is a key thing. I mean, we've just come through a very, very nasty period, and people are very sensitive about these changes.
Jim Stening, thank you very much for your time today from FIIG Securities. Thank you.
Thanks.
That's Jim Stening, Managing Director, in fact, of FIIG Securities.